Most people expect financial growth to look dramatic. The truth is quieter, and that's exactly why it works. Stay with me. At the end, I'll give you a short checklist you can use this week to start quiet growth. Watch to the end for 5 simple actions that protect momentum and make small habits compound into real wealth. Hello and welcome. This is Quiet Wealth Insights. If this is your first time here, my name is Godwin, and the purpose of this channel is to explain money in a clear, steady way without noise or pressure. If you're looking for clear, calm, and practical insights about money, this channel is for you. Most people think financial growth is something you can see. They picture big changes, noticeable upgrades, moments where life suddenly looks different, a new lifestyle, a turning point, a clear before and after. But real financial growth, especially the kind that lasts, rarely looks like that. It's quiet. It doesn't announce itself. It doesn't arrive on a timeline that feels exciting. And most of the time, it doesn't feel like progress while it's happening. That's why so many people miss it. What actually separates people who slowly build financial momentum from those who keep resetting isn't a secret strategy or special insight. It's a set of quiet rules that don't sound impressive and don't produce immediate validation. The principles I'm about to share are not complicated, and they're not extreme. They're simple foundations that, when followed consistently, can quietly change your financial direction. Let's go through these 9 rules one by one. Rule 1, growth usually feels boring at the beginning. Early financial growth doesn't change your daily life in obvious ways. Bills still exist. Pressure still shows up. You still look and feel normal. You may be saving consistently. You may be learning. You may even be investing responsibly. But nothing looks different yet. And that's exactly why this stage works. The early phase of growth is about building structure, not results. It's about putting things in place before they have anything to show for themselves. Most people abandon this phase because they expect visible change too soon. They assume that if nothing feels different, nothing is happening. Quiet growth works in the opposite direction. It requires consistency while nothing dramatic occurs, long enough for progress to shift from small to meaningful. Rule 2, interruption is more dangerous than failure. Most people don't damage their finances with one bad decision. They damage them by stopping and restarting repeatedly. They save for a while, then drain it. They begin a plan, then abandon it when life becomes uncomfortable. They invest, then panic and pull out. Each interruption forces progress to restart from a lower base. And what's usually lost isn't just money. It's time. Time is the amplifier. Money grows best when it stays positioned long enough to layer on itself. Interruptions break that layering. Quiet growth isn't about being perfect. It's about being stable enough to stay in the game. Rule 3. Financial growth is more behavioral than mathematical. People like numbers because numbers feel objective. They feel controllable. But most long-term financial outcomes are shaped by behavior, the ability to wait, the ability to avoid emotional decisions, the ability to stay consistent when progress feels slow, the ability to resist expanding lifestyle every time income increases. 2 people can follow the same approach, yet the one with steadier behavior usually ends up further ahead. A plan that you abandon isn't a plan. It's an idea. Quiet growth relies less on clever tactics and more on reliable behavior over long periods. Rule 4, income is a tool, not an automatic solution. Higher income helps, but it doesn't automatically create growth. Many people increase their income and remain financially stuck. The reason is simple. Income is only a tool. What matters is what income becomes after life takes its share. If higher income turns into higher spending and higher obligations, nothing changes structurally. Life becomes more expensive, but not more stable. Quiet growth happens when income increases while structure remains deliberate, not restrictive, not harsh, just intentional. A person with moderate income and strong structure often grows faster than someone with high income and weak structure. Rule 5. Savings are shock absorbers, not the finish line. Saving is important. It provides stability. It prevents panic. It gives you room to breathe. But saving is not designed to finish the job. It's designed to stabilize the job. Savings are the shock absorbers of your financial life. They reduce the impact of disruption. Quiet growth uses savings as a foundation, not a destination. When saving becomes the end goal, growth tends to stall because money that remains still for too long becomes vulnerable in ways that aren't obvious day to day. Rule 6. Ownership changes the dynamic. When progress depends entirely on earning, it remains tightly tied to effort. You work. You earn. You stop. Income slows. Ownership changes that dynamic. It allows something you own, assets, systems, structures, to continue participating even when you're not actively trading time for money. This doesn't mean everyone needs a business or complex arrangements. It means growth becomes easier when effort and time are allowed to work together rather than separately. Rule 7. Still money loses ground quietly. Inflation also plays a quiet role in shaping results. Money that stays still loses ground over time, not dramatically. People often feel like they're doing everything right yet still falling behind. The issue isn't effort. It's stillness in a changing environment. Quiet growth understands that stillness has a cost, not because risk should be chased, but because money needs to participate. Rule 8. Humility matters early. Early growth requires accepting that you don't yet have proof. You have structure and consistency, but not evidence. That makes comparison tempting. It makes louder decisions appealing. It makes people want to force visible progress. Quiet growth resists that urge. It chooses reality over ego. Trying to look successful before being secure is one of the most expensive financial decisions people make. Over time, all of these rules point toward one larger truth. Growth is rarely about the best move. It's about the best direction. People often search for the perfect decision, the optimal path, the safest strategy, but direction matters more than optimization. A person moving steadily in a sensible direction will usually outperform someone who keeps searching for perfection, but never stays positioned long enough. Trying to be perfect often becomes a sophisticated form of delay. Quiet growth prefers consistency over brilliance. The final rule: stay calm. The real work is staying calm. Financial growth doesn't just test knowledge. It tests temperament. What you do when progress feels slow. What you do when uncertainty rises. What you do when fear appears. Most people don't lose because they chose the wrong thing. They lose because they react. Quiet growth is built on calm decisions repeated over time, not dramatic moves. Not constant adjustment, calm decisions, repeated. If this way of thinking about money resonates with you, you can like the video. It helps this calm style reach people who prefer clarity over noise. You're also welcome to subscribe to Quiet Wealth Insights if you want more discussions like this. And if you have thoughts or questions, feel free to leave a comment. I read everyone, and I do reply. You can also watch the earlier videos on the channel. Each one looks at these ideas from a slightly different angle, and together they tend to form a clearer picture. Quiet growth doesn't need to impress anyone. It needs to last. And the people who understand that often end up with something more valuable than a dramatic financial story. They end up with resilience. They end up with flexibility. They end up with a financial life that doesn't rely on constant pressure to maintain. That's what quiet financial growth usually produces. Thanks for watching. If you stayed to the end, here are 5 small actions you can start this week. Automate 1 small transfer. Protect continuity for 90 days. Keep savings as a buffer. Own 1 simple asset. Pause before lifestyle upgrades. Try one and tell me which one in the comments.